If you have $100,000 sitting in a bond fund tonight, the United States Treasury just made a decision about it. And the decision was to become the buyer of its own debt. Starting September 9th, the Treasury will at least double the amount of its own long term bonds it buys back, from $2 billion in operation to at least $4 billion. $4 billion is every household in America chipping in 30 bucks per operation. They announced it one day after the 30-year bond hit 5.338%, the highest since 2007. And almost nobody noticed what that pairing actually means. Because here's what those two facts do to your $100,000. When that yield was rising, your bond fund was falling. A 1 point rise in the 10-year takes roughly $5,500 off a $100,000 bond position. That's the fire. Today, the government showed up with a hose. Your statement will look better this month. But the water in that hose is the question of this entire video. Because the one number that's supposed to tell you the truth about your savings just got a thumb on the scale. And I'm going to show you exactly whose thumb, what it weighs, and where the truth goes once the scale stops working. Let's start with what actually happened, in plain words. When Washington spends more than it collects, it borrows. It borrows by selling bonds, an IOU that says, lend me money for 30 years and I'll pay you interest. Simple. And like anything sold at auction, the price depends on who shows up to bid. Lately, fewer people have been showing up for the long ones. Yesterday, the 30-year Treasury hit 5.338%, highest since 2007, before the financial crisis, before any of this. The 10-year touched 4.712 this morning. Now, a higher yield sounds like good news if you're a saver. More interest, right? Here's the part they skip. A bond's yield only goes up because its price went down. And its price went down because buyers were walking away. That number isn't a reward, it's a thermometer. And it was reading a fever. So this afternoon, the Treasury Department made its move. It announced it will at least double its buybacks of long-dated bonds, the 10 to 20-year paper and the 20 to 30-year paper, from $2 billion per operation to at least $4 billion, effective September 9th, running through November 4th. Read that back slowly. The organization that sells the bonds announced it will be buying the bonds. Picture a car dealer who can't move his trucks at the sticker price. So he sends a guy to the auction to buy his own trucks back, and the sticker holds. The lot looks healthy, but the demand? The demand is him. And it worked instantly. The 10-year yield dropped from 4.712 to 4.651 within the hour. That speed is the tell. When one $4 billion hose puts out the fire that fast, it tells you how little real water anyone else was bringing. Now, I want to be straight with you, because being straight is the only product this channel sells. Officially, this is a liquidity operation, smoothing out a choppy market. That is a real thing, it's legal, and they published it in the open. Nobody's hiding a document. What they can't publish away is what the move reveals. That's our story. Stay with me, because the next part is where it starts costing you money. The long bond has one job. It's the market's honest opinion. Millions of strangers betting their own money on what it costs to lend to the United States for 30 years. It prices in inflation. It prices in deficits. It prices in one blunt question. Will I be paid back in dollars that still buy something? When that number says 5.33, it's saying, we have doubts. Today, the issuer of the bonds reached over and adjusted the number. They didn't cool the room, they taped over the thermometer. And look at what else moved this afternoon, all in the same few hours. The dollar index fell 0.75% to a 2.5-month low. Gold jumped 3.5% to $4,484 an ounce. If you hold $50,000 in gold, that was $1,700 today while you did nothing. Silver up 3.3. The gold miners up almost 9%. And Bitcoin ran from about 64,700 to a high of 69,700. Stocks up, bonds up, gold up, dollar down, all at once. Here's why that pattern matters. When people are scared, they buy gold and the dollar together. That's fear. When gold goes up while the dollar goes down, that's not fear. That's a repricing. That's money quietly deciding the dollars themselves will be worth less and moving to things that can't be watered down. Which brings us to what this costs you, because it will never show up as a loss on any statement you receive. If you hold bonds, tonight you're up. Prices rose. Nobody touched your account. But think about what a bond is: a promise of future dollars. And the dollars that bond pays you in 2046 just got a little easier to create because the entity that prints them showed today that it will step in whenever the market prices its debt somewhere uncomfortable. Your slice of pizza is the same size on the box. They're just cutting the pie into more slices. The nominal number holds. The purchasing power under it thins. Quietest transfer in all of finance. Now stack the timing. 3 weeks ago, the July jobs report, minus 23,000. The economy lost jobs. A whole stadium of paychecks, gone. May got revised down by 66,000 and June by 37. 103,000 jobs that were announced and then quietly taken back. Fewer working age people are even in the game. Participation is down 7/10 of a point since January. So, a weakening job market. A long bond nobody wanted at 5 1/3. An issuer now volunteering to buy it. And one more twist. The futures market is pricing a 35% chance the Federal Reserve raises rates at its September 15th, 16th meeting. Hold that picture. The Treasury is pushing long-term rates down, while the Fed might push short-term rates up. One foot on the gas, one foot on the brake, same car. And you're in the back seat. Historically, when a government drives like that, the thing that tears isn't the engine, it's the currency. I track every one of these dials: the long bond thermometer, the dollar index, the buyback calendar, on one dashboard every morning. And I'll tell you where to find it in a few minutes. First, the part of this story nobody covered today: the inventory. Here's the exercise. Take everything you own and ask one question about each item. Who can make more of this? Your Treasury bonds. The issuer is the Treasury. It can print more bonds any Tuesday it likes, and as of today, it also buys them back to hold the price up. Both sides of the market, same hand. Your dollars, issued by the Federal Reserve. And remember, the Fed already stopped shrinking its pile. Quantitative tightening, the program that was slowly pulling dollars back out of the system, formally ended December 1st of last year. The shrinking is over. From here, the size of the dollar supply is a committee's choice. Your stocks. Companies issue shares. A board votes, and there are more shares, and yours is a smaller slice. It happens every day. Your house. Honestly, one of the better things on the list, and I've said so for years. Nobody prints another lot on your street, but its price is quoted in dollars, its tax rate is set by an authority, and its buyers borrow against the same yield curve we just watched get managed by hand. Gold. Give gold its due. It did its job today. 3.5%, $1,700 on a $50,000 holding. No CEO, no issuer. I respect the metal. But your gold has to sit somewhere. A vault has an owner. An ETF has a sponsor. And in 1933, the government called the citizens gold in. That's not a theory. It's an executive order with a number on it. 6102. You can read it tonight. The metal has no issuer. The access usually does. Run the list one more time. The bonds, the dollars, the stocks, the house, even the safe haven metal. Every single one has a person, a committee, or a board somewhere that can make more of it, or stand between you and it. That's not a scandal. That's just what issued assets are. It's the deal, and it's always been the deal. All today did was demonstrate the deal in broad daylight. If the market prices our paper where we don't like it, we will take the other side of the trade. So here's the question the whole day has been walking toward, the one I opened this video with. If the honest number gets a thumb on the scale, where does the truth go? Where does money run when it wants a scale nobody can lean on? You already know the answer, because you watched it happen at 6 o'clock tonight. There is exactly one item you could add to that list, where the answer to who can make more of this is nobody. Bitcoin. 21 million coins. That's not a target and not a policy, it's the rule the network runs on, checked by tens of thousands of computers around the world, every 10 minutes, none of whom answer to a Treasury secretary. To change it, the people running those machines would have to vote against their own wallets. In 17 years, it has never happened. There is no Bitcoin buyback program because there is no issuer to run one. No servers, only a protocol. Think of it like land on an island where no new land can ever be made. Not, probably won't be made. Can't. The rules of the island don't have a department that makes land. And today, while the Treasury was steadying its own market, Bitcoin moved. 64,700 this morning, a high of 69,700 this afternoon. Call it 7.5% inside the session, settling near 68,700 as I record, up 6% on the day. If you held $10,000 of Bitcoin at breakfast, it's about 10,600 at dinner. Trading volume up 46%. Now let me be careful here, because this is exactly where other channels lose the thread. I am not telling you Bitcoin jumped because of a Treasury press release. Bitcoin moves for a dozen reasons on any Tuesday, and some of today was surely leveraged bets getting flushed. And I am not giving you a price target. That's not what this channel does, and it's not what this asset is for. What I'm showing you is what Bitcoin moved with. It rose with gold, with silver, with the miners, while the dollar fell. It did not trade like a tech stock today. It traded like the metal. That's the market doing the same inventory we just did, sorting every asset by one question. Who can make more of this? And putting Bitcoin on the only side of the line where the answer is no one. Here's the whole mechanism in one breath. Every problem in this video has the same root. The thing you're holding can be made more of by someone who benefits from making more of it. The deficit is funded by issuing. The yield is managed by buying. The currency is thinned by both. Bitcoin is the one asset where that sentence has no subject. Not because it's magic, because the arithmetic was locked before any of us arrived, and the only people who could ever change it are the ones it would cost. The news was the door. This is the room. And notice, I didn't drag you here. The story walked here on its own. It keeps doing that. If you want to watch this exact mechanism instead of taking my word for it, the Macro Command Center at timtalksfinance.com/members has the dashboard I use every morning. The piece that matters this week is the yield tracker, the same 30-year number we've talked about tonight, updated daily, next to Bitcoin and gold, so you can watch whether they keep moving together. Because if they do, that's the market telling you this wasn't a one-day story, and you'll see it there before I can make a video about it. Time to pay off the question from the top. Whose thumb, what does it weigh, and where does the truth go? The thumb belongs to the Treasury. It weighs $4 billion in operation, effective September 9th. And the truth, the market's real opinion of 30 years of American promises, went where it always goes when a scale gets leaned on. It went looking for a scale that can't be. Today that looked like gold at 44.84 and Bitcoin at 69.7. But there are no certainties in this business, only probabilities. So, two scenarios, and you decide which one you're watching. Scenario 1. This is plumbing, nothing more. 4 billion in operation against a treasury market measured in the tens of trillions is a garden hose on a lake. August is thin, the dealers were clogged, Treasury greased the pipes, and by October, nobody remembers. Bitcoin gives back most of today because today was leverage, not conviction. Honestly, over the next few weeks, this is the more likely story. Scenario 2. This is step 1. The buyback gets extended past November 4th and gets bigger. Step 2. The Treasury starts shrinking its long bond auctions, selling less 30-year paper because there aren't enough honest buyers at a price it can stomach. And if the long end still won't clear, the buyer of last resort stops being the Treasury and becomes the Federal Reserve. And at that point, we're not discussing plumbing anymore. We're discussing a government printing money to buy its own debt. The dollar will smell that long before anyone says it out loud. On a $400,000 retirement, every 1% the dollar quietly gives up is $4,000 of groceries and gas that walked out the door without a receipt. I don't know which scenario this is, neither does anyone on television, but you don't need to guess, because there are three signals coming: specific, dated, checkable. Write them down. Signal 1, September 9th, the first $4 billion operation. Watch one thing: whether the cap gets raised again before November 4th. Once is plumbing, twice in 2 months is a policy. Signal 2, the next quarterly refunding announcement, when Treasury publishes how much long-term debt it plans to sell. If those long bond auctions shrink, that's the quiet admission. They're not just supporting the price anymore, they can't place the paper. Signal 3, September 15th and 16th, the Fed meeting. Markets give 1 in 3 odds of a rate hike. If the Fed tightens while the Treasury loosens, both feet are on the pedals, and you'll want to be watching what the dollar does, not what the press conference says. One line to take with you tonight: when the seller of an asset has to become its buyer, the price was already telling you the truth, and the only exit that can't be bought back is the one with no issuer. I'll be tracking all three signals on the dashboard, and I'll bring you each one as it lands. September 9th is 3 weeks out, so if you're not subscribed, this is the one stretch of the calendar you don't want to lose the thread on. I'm Tim. I'll see you tomorrow.